Sure. Good afternoon to all the participants. Today we are here to attend the live webcast on findings of the peer review exercise of the valuation reports for the financial year 23-24. The webcast will be taken by CATV Subramaniam sir. Sir is a graduate in commerce, a fellow member of the Institute of Chartered Accountants of India, registered insolvency professional as well as a registered valuer. Sir has over 20 years of experience in valuation engagements, which spread across industries like varied industries, and it goes into fields like mergers, acquisitions, purchase price allocation, negotiations for buyers. Sir is a specialist in business valuations, business processes and strategy consulting, forensic analysis and investigations. Sir has also been part of faculty for ICI's valuation forensic courses. With that, we give over the stage to CA Balasubramaniam. A very warm welcome to you, sir.
Thank you. Thank you all for participating in this. Let me first share the screen and then we can take the discussions forward.
Sure, sir.
Yeah. Good afternoon, one and all. Today we are going to be discussing on the findings coming from peer review done in 23-24, right? So this is something interesting, and it also gives some insights as to what has been the progress which has happened over the last few years in valuation as seen from the ICARVO side. And also where as valuers we need to probably take some improvement measures. So without much ado, let me take you on to the specific findings and specific points which we need to take note of. So essentially, this peer review exercises have been done in the past also. So there have been specific peer reviews which have been done from 2019-20 financial year itself covering this. So there have been 4 financial years which have been covered till now. And there is a specific requirement that there should be a peer review process with the ICARVO as per the IPBI guidelines. So this is actually done in accordance with that and coming from there. So in continuation of what we saw, 2021, 22, 23 year ends, and then now 24th year end, 5 years, 5th year's review has been covered in this. 168 reports have been covered in the peer review exercise. 72 are from registered valuers entity, covering about 15 registered valuers entities, and 96 reports are from 20 registered valuers. So in carrying out this peer review, what is the scope and coverage? So let's first understand that. So it's essentially to look at compliance with the provisions, right? Companies Act and the rules thereunder, the valuation standards which have been adhered to. As you know, ICA valuation standards are one option. There are also other international valuation standards which could be used in some cases by some valuers. So compliance with the requirements of the selected valuation standard in the concerned valuation reports. Then any other applicable rules, regulations, etc. For example, if it's a valuation under IBC, whether the requirements which are there have been covered with regard to specifically with regard to valuation. So those are the things which are being looked at. There could be a valuation under income tax. So then there is a rule which is prescribed as to how the valuation should be done. So it will be seen in that context. So accordingly, all that will be the coverage which is looked at. Now, the entities which are covered, the sample size, etc., are decided by the ICARVO, and it is also communicated to the reviewer as to what should be covered. So there is a detailed checklist which is used. So there is a consistency in how the review is done by different peer reviewers also. So there is a peer review checklist which has been made specific to look at for the valuation reports and what should be looked for in that and specifically reported upon. So there is a consistency and comprehensiveness in what is covered by different reviewers. So I was explaining there is a detailed questionnaire which is designed to assess the compliance levels, right? Broadly, this is classified into 6 large criteria, right? One is general compliance. The second is specifically compliance with Section 8.1 or Rule 8.1 requirements under the company's valuation rules. The second is next is about coverage under 8.2 of the valuation rules. Similarly, 8.3 requirements of 8.3 under the valuation rules. Then looking at broader things of whether the information for intended users are covered well. So that is the next aspect. And sufficiency of compliance in communicating with intended users, right? So like this, it has been divided into 6 parts. In addition, of course, there could be always value-added suggestions which could come from various peer reviewers on anything they have noticed in the process. So this is how the peer review process is taken up based on specific areas which are identified and specific aspects which needs to be covered under each of these 6 broad criteria. So in this, there are different parties who are involved in this. So there are peer reviewers who do the review. So how is the process is happening and the interlinkages are happening? So first and foremost, to maintain confidentiality and ICA RVO coordinates this whole thing in a centralized manner. So no peer reviewer directly deals with the reviewee. Now, many of us being chartered accountants, we may be aware of the peer review process under the ICA guidelines for CAs. There, it simply is passed on. So there is a direct connect between the reviewer and the reviewee in all the CA reviews which are happening, audit peer reviews. However, in the valuation, very clearly everything is routed through the ICAI. The key informations are redacted before it is shared with the reviewer for him to review. So he's reviewing without any bias, which can come from the knowledge of who's the valuer, which is the entity which is being valued or the asset being valued. Was there any public domain discussions, etc., around that entity being valued? All that cannot come and create a bias by having redacted all this. So identity of valuer is redacted. The peer reviewer should be an experienced person in the relevant field. So there is a criteria by which peer reviewers are selected and a panel is maintained, and it is only within this peer reviewers the peer review allocation is being done. The reviewer also is not given access to, in the case of a peer review, the reviewer is not given access to any of the working papers. So he gets to see only the product. And then based on that product, he takes a view. And the reviewer is expected to be free of potential bias, right? And to enable all this only, there is also certain key things which are redacted so that peer reviewer is not even given such information which could create probably a bias. So there is a peer review panel which currently consists of about 15 RVs which were used for 23-24, which includes members of ICA RVO Advisory Committee, duly constituted within the ambit of ICA RVO peer review policy. And these RVs were given the task of conducting the peer review of selected 168 reports, which comes from some from RVEs and some from RVs, registered valuer entities and registered valuers. So broadly, what are the terms of reference for the reviewers? To give an opinion on the quality of the valuation report under review, basis the key aspects to be reviewed. The key aspects have been already defined. Like I said, there are so that 6 criteria under which it are aggregated and presented. And in that, to come up with an opinion on the quality of the valuation report which is being seen. So also specifically to review the compliance with Rule 8, sub rules 1, 2, 3, all of them being specifically looked at. And also any other specific guidelines or rules or regulations which would apply to the given valuation engagement. The peer reviewer is not supposed to make an opinion on the conclusion of value, even if he presumes that in his opinion, the value should be something else. That is not his outlook. That is not what he is supposed to report upon. He's supposed to only report upon the process of the valuation report being drafted and the quality of the valuation report, not getting into the conclusion of value, which is purely left to the discretion of the valuer who has already given it. So it's not to question his valuation. It is more to question the process or give improvement suggestions to the quality of undertaking the valuation. They also expected to maintain confidentiality. Like I said, to enable confidentiality, a lot of critical things are redacted, but still there is some amount of information which will be there, like the WAC rates which have been used, that the discounts which have been applied, the premiums which have been applied, some projection numbers could be there in the financials which are presented for the purpose of valuation. All that which is there in the report is expected to maintain confidentiality. Then, whenever he gets a review engagement, is also to ensure that he is not reviewing something where there could be interest. For instance, there could be cases where there are 2 valuations required, like under IBC. If the peer reviewer happened to be one of the valuers and the other valuer's report is coming up for a peer review, he is supposed to revert back saying that there is a conflict and he should not do that. And the peer review has to submit his findings in a standard format which has been developed by ICAI RBO, so that there is structure and system to the whole thing. The whole process is well structured and is able to be used for better understanding and better sharing of inputs. So before we go into the specifics, let's look at some broad overviews, right? Some quantitative analysis of what it looks like. So let's start from there, and then we can come down to other things. So like if you look at it, again, this 168 valuation report reviewed based on the 6 broad criteria which was put in. So general compliance, compliance with Rule 8.1, compliance with Rule 8.2, and then compliance with Rule 8.3, whether information for intended users fairly and well presented, and whether there is a sufficiency in communication with intended users. So in this 6 criteria, the whole thing has been analyzed and presented. So if you look at it, as I was saying, the whole peer review is based on only the valuation report. One of the things noticed is that the date of appointment is not specifically mentioned in some 24%, say one-fourth of the valuation reports. It's not giving it. So this was one of the items which are noticed. However, it is quite possible that the date of appointment is anyway separately covered under the engagement letters, but it may be a good idea to have the date of appointment also brought into the valuation report. So there is comprehensiveness of communication which is happening in the or through the report. Date of submission of the valuation report has been given in all cases. Interestingly, in 2% of the reports, it was found 2% is nearly about 3 to 4 reports. The valuation date itself is not mentioned, which is very, very critical. Though the percentage wise, the failures there are very limited, it is a critical field which has not been given. And generally, it is noticed that the fees received is not given in the valuation report. It's not a mandatory requirement there. It can be there in the EL. So in about 1 or 2 reports only, it was noticed that the fee is also mentioned in the report itself. Otherwise, generally, fee is not given in the report. But that is something which is also specifically looked at. So as he was explaining, this date of appointment, right, is a critical field. Though, like I said, it might be there in the engagement letter, it may be a very good idea to have it as part of the valuation report to ensure that it is comprehensive in presentation. Date of submission and valuation report, of course, perfectly fine. Like I said, valuation report, even 2% valuation date being missed is a significant thing because that is critical. We are talking about a value as of a date, and that date is not mentioned. It makes it critical, really. It makes it significantly deficient, the reports, underlying reports. So largely on the general criterias, there is very good adherence. There is no major concern which is there. And this is a significant improvement over the periods also. Let's look at Rule 81 compliance, right? So what is it that it talks about? Whether they have utilized the ICA evaluation standard, whether they have utilized other valuation standards, right? And scope of valuation standard, whether they have specifically cleared as per 201 or otherwise, wherever ICA evaluation standards have been used. So interestingly, where ICA evaluation standards seem to have been used, there is again about 1/5 of the reports which do not explicitly contain a declaration to this effect. There must be an explicit statement of compliance with a particular standard, right? So this is something which needs to be using. And whenever there is a utilization of other valuation standards, only 15% of the reports followed other valuation standards, in contrast to 51 did not follow any other valuation standard. And 35%, it was not even applicable. So basically, they were going by 11 UA or things like that. So this is another area which needs to be looked at and addressed specifically. And when ICA evaluation standards are being used, specifically, there must be a look at how the scope is defined in alignment with VS 201. So that is probably also an area which can be focused upon going forward from valuer's perspective. Overall, of course, there is a strong adherence to ICA's valuation standards, which is good, having developed that, and that is a very important thing which needs to be done. The next is compliance with Rule 8.2, right, where we are talking about compliances relating to use of other valuers reports or other valuers for certain specific area, right? So whenever there is another valuer engaged, then there should be specific disclosures relating to that in the valuation report. Now, this raises four different possibilities where we had used a P&M valuer, where we had used a LNB valuer for some assets, where we had used another SFA valuer for some assets. It's possible that though we are doing SFA valuation, we may have got another SFA to do some part of the assets. The fourth is where they were not used as a valuer directly, but more as an expert, right? So we use them as an expert in our utilization. So interestingly here, right, in a majority case, as you can see, right, there is no reliance placed on other valuers report, right? So only one or two instances were noticed where the valuation depended on valuation done by a P&M or a LNB valuer. There were also a few cases where valuation reports were done by part of the valuation reports were done by other SFAs, and those reliances were used. In all these cases, adequate disclosures have also been made, right? And none of the reports which were examined showed any reliance placed on a registered valuer used only as an expert, not as a valuer for certain assets. So by and large, the compliance was good here, that adequate disclosures have been made wherever it was relied upon based on other valuers, etc. Right? The next is about the criteria under Rule 8.3. This has large number of criteria which needs to be looked at. So in Rule 8.3, the various things which are expected is background information of the asset. As you can see, there is a significant amount of compliance in disclosing that. Purpose of valuation and the appointing authority has been there in all the cases which were covered by the review. Identity of the valuer and any other experts involved in the valuation. In some cases, there was nothing, but in other cases, it has been specifically highlighted. Disclosure of valuer's interest or conflict, or a specific statement that there is a lack of such interest or conflict, was there in a significant percentage of cases. However, what is to be noted is around 17% of the cases, this was not there. So we'll look at that in more detail here. So background information on the asset, though I said a significant amount of coverage is there, around 6% non-compliance was there. So there is room for that improvement. Purpose of valuation report, nearly everybody had said, right? Only in two reports did not mention the appointing authority, who had appointed. Identity of the valuer, 2% did not comply and 14% was not applicable. There were instances where the valuer mentioned relying on other valuation reports, but did not detail the respective valuers. So what had happened is they had just said that the values of the P&M has been taken. Example, P&M has been taken based on valuation done by a registered valuer of the P&M asset class, but they had not gone on to give the details of who's that valuer, the value, etc. So it is a mandatory requirement that the other valuers who are involved along with their registration numbers have to be included in the report. So that is how you can place reliance on that. So that is a critical requirement which needs to be addressed. Though, of course, it's not a large number of cases, it still is an area which needs improvement, surely. Disclosure of values, interest, or conflict. Like I said, a specific statement saying that there is no interest in the asset or no interest expected to be there in the asset, and there is no conflict of interest, etc., should be a specific confirmation which should be included in the valuation reports. It's a mandatory requirement. So that has been missed out in a reasonably larger number of cases. So this is one area which needs improvement. And these things can be addressed by having some standard sections and standard minimum disclosures which are included in the valuation report. So these things are not missed out. So the areas of improvement on this account needs to be specifically considered. Now, like I said, Rule 8.3 is a larger thing. So continuing on the requirements under Rule 8.3, the next is to have presented the three important dates in the valuation report. So what are these three important dates? The appointment date, the valuation date, and the valuation report date. All three must get presented. As you can see, 90% compliance is there. Then a detailing of what inspections and/or investigations were undertaken by the valuer in the process of valuation. So there also, there was a significant amount, 31% says no, which is materially large. So this is one area which needs some attention. Then nature and sources of the information used or relied upon have been broadly covered in nearly all cases. Only 4% variation was there. And detailing out of the procedures adopted in carrying out the valuation standards, right? That also was missing in about 13%. 13% is again somewhere, it's not significantly large, but yes, there could be room for improvement there. So as I was saying, the major area of concern is with regard to the inspections or investigations undertaken, the analysis, right? What analysis was performed in the process of valuation? That is not there in about 30+%. Nearly every other third report did not have it. So, which is a material area for attention of all valuers to improve the process going forward. Coming to the non-reporting of all the three dates and also the procedures adopted in carrying out valuation standards, these are some minor gaps in a lesser number of cases, which also is important for us to understand and improve our reporting. Inspections and investigations is at a serious level. A large number of reports not having it puts big question mark on the valuation process, whereas these two are not so materially large in terms of gaps. So these can also be addressed, however, by everyone. Again, many of these can be easily addressed by having some standard placeholders, standard structure to the report, standard requirements, which minimum requirements to be presented in the report, etc. So that is something which needs to be taken care of. So again, further continuing on this, class 8.3 is the most critical and large area of coverage which needs to be looked at. Right. The report should specifically restrict its use for particular purposes, time frame, etc. Right? So one of the key things is whether such restrictions have been specified in the report, because this is also a mandatory requirement under the regulations and rules. So it was noticed again in about 13% of cases, it was not there. This is something which needs to be surely looked at. Then, what were the major factors that were taken into account during the evaluation? One-fourth of the reports do not talk about it. This again is something which is important, which needs to be addressed. Conclusion is missed out in only about 2% of the cases. Caveats, limitations, and disclaimers, to the extent it can be given, right? There is a specific requirement that caveats, limitations, and disclaimers can only be to the extent that they explain or elucidate the limitations faced by the valuer and should not be limiting his responsibility for the valuation report. So what he has to do cannot be waived away by putting a caveat, limitation, or disclaimer. So it should be only to explain and elucidate the limitations under which the valuation exercise has been carried out or related issues to that. So that is missing in about 5% of the cases, which is an area which can be looked at. So again, reiterating on this, the restrictions on use of the report, though there is a fairly high level of compliance, 13% is substantial enough to look for some improvement thereon. The restrictions, in my personal view, should have two sides to it. One is the purpose for which the report can be used, and some time limits within which it should be used and beyond which it should not be used even for that purpose, because with time things could change. So it's all values are has been taken at 25%. Now, why 25%? Why not 35%? Why not 26%? Why not 21%? How did the WAC get computed and compiled? There is absolutely no description. So we need to see whether we are giving adequate and appropriate disclosures in these aspects. Please also notice that the base and premise of value itself has not been disclosed in more than 1/6 of the reports. Though from a percentage perspective, 83% looks good, 1/6 of the reports have not mentioned the base and premise of value, which is the essence of the report also. All these are critical essences. So ideally, we should be seeing a 0% non-compliance, or maybe a couple of percent non-compliance is fine, but this is concerning that in 1/6 of the reports, the base and premise have not been disclosed. It is not that the valuer has not considered some base and premise in the valuation. It is only that he did not disclose what is the base and premise, and if required, a explanation as to why that has been chosen. Right? It is critical to document it. It is not enough that it is there in our minds. It should be there in the report also. So we need to ensure that this is being addressed. Whenever there is significant uncertainty that directly affects the valuation, there should be specific description which is given. Again, here, like I said, in about 50% or 45%, say half the cases, it's not even applicable. In the other half, a half is missing. So nearly 50% of the cases where it is required, it is not being given. So this again is an area of concern which needs to be specifically addressed, right? So there is a significant room for improvement in respect of a few of these areas. One is special assumptions. Wherever in the valuation we are using some special assumptions, some exclusive or something unique, we need to make specific disclosures and maybe some rationale wherever required to explain and justify that. And wherever there is significant uncertainty, which has to be read with in the context of the valuation which is being presented. So these two, there is a significant amount of compliance which is required. The other areas where improvements can be there is in general disclosure of assumptions, the base of valuation, the premise of valuation, etc. So there is room to improve there also. Even with regard to the description of scope and the intended use, we should ideally achieve 100% compliance there, because that is the crux of the report. Now, you have not even stated why the report is being made and the report is being prepared. So it is important that these are addressed and taken care going forward. Continuing further on that, whether limiting conditions that directly affect the valuation is being dealt with appropriately or not. In about 10% of the cases, it was not. In 20%, it was not even applicable. So this is fairly okay. Reasonable compliance is there in that. Whether the report gives a comprehensive narrative, by and large, yes, very little room for improvement there. Whether an abbreviated summary report is presented, like an executive summary, etc. In only about 1/4 of the cases, it was being presented. In many cases, it was not. This is more an value add, right? This is not a category issue, but still it has been highlighted so that we can see how it can lead to improvement. Then whenever there is a variations in standard, right, whether appropriate disclosures have been given for that, and rationale, etc., has been given. That is the next thing. Additional requirements reported for variations from standards, whether that has been done or not. You can see that 36% has not been done. Wherever ICA evaluation standards have been used, whether it just says ICA evaluation standard or the specific standards have also been referred to. There also, again, in many cases, it's not being referred specifically, right? Whether the valuation is done under a specific standards, that is not being brought out. So looking at it again, as you can see, the summary report or executive summary, yes, there is room to improve. There is more which can be brought in there. Absolutely, that's one area which can be looked at, right? And any variance in standards, only about 9% had varied from standards. So they have aligned with the standards largely, right? Wherever there was a variation in standard, whether additional requirements have been reported, largely did not require any reporting, right? But wherever reporting was required, as can be seen, in 36%, they have not reported, which is not a good sign. That is something which needs to be improved. The other area where there can be improvement is to specifically mention the individual standards which are being specifically used in the valuation. So that is something 301, 302, 302. So all that, whether which one has been used for the valuation, would be a very important and useful thing to present in the report going forward. That's missing in many cases. So that's again one area where large number of reports have gaps which can be improved upon. The next is sufficiency of compliance in communicating with intended users. Whether the scope of valuation assignment has been communicated, the work performed, the conclusions reached, principal reasons for the conclusions reached, and adequate information to enable review of the report. So largely here we find that there is better compliance in the narratives which are given, and some small room for improvements are there surely, right? Like in having enough information for a reviewer to be able to review or anybody else to be able to review. Some improvements which are possible in terms of the principal reasons for the conclusions reached, etc. So largely communications were decent and good in the report. So this is what the quantitative analysis is bringing about from the last 1 year's reports being peer reviewed. Now, having looked at just some numerical analysis, let's look at it from a qualitative perspective as to what is it that is being noticed and what can be looked at, right? The first one is with regard to general findings, right? So date of appointment, like we mentioned earlier, in many cases it was not being put. So date of appointment, yes, if you go back to the EL, it will be there probably. But it is good idea to bring all this. So the valuation report, one of the structure you can bring in somewhere is to ensure that there are placeholders put for giving this information in totality, maybe in one place if required. The date of submission was there in all the cases. The valuation date, very interestingly, about 2% of the cases did not contain the valuation date. Now, how a value is presented without a particular date, because the whole concept of value is that it is a value as of a given date. That date, if it is not mentioned, then where do we go from there is the question which comes up. Coming to comparatively, right, the findings under 8.1, we notice that fair amount of compliance was there, right? 77% utilized ICA valuation standards, and then others had used other valuation standards, maybe based on specific requirements, etc. Maybe even based on the requirements of the client in that regard. So scope of work, 84% of the report contained scope as per VS 201. In 14%, the scope was not given as per the requirements of VS 201. Now, this is one area which can surely have some improvement brought in. So this is something which needs to be kept in mind from a qualitative perspective. Coming to the next rule, 8.2, right, where adequate disclosure is being made for the inputs obtained, right, especially when there are separate valuations done for certain classes of asset. So in this whole sample which was verified, there was only one instance of RV relying on the work of a P&F valuer. Similarly, there were two instances where the RV was relying on the work of L&B valuer, right? And around 3% of the reports had valuers relying on other SFA valuers' reports. And in none of the 168 reports, there was a valuer engaged as an expert for a particular asset. So that was not there at all, right? So this shows that significantly there was not much to worry about on the use of other valuers. But like I was mentioning earlier, in some cases when the other valuers have been used, though the number of cases themselves are very few, right? The full details were not presented in the report. That is a key requirement which needs to be addressed. We need to take care of that going forward. The next aspect is the background information on the asset being valued. In 6% of the reports, that was not specifically highlighted, right? The background of the assets which are being valued. And in respect of purpose of valuation and appointing authority, two reports did not mention the appointing authority. Who had made the appointment was not mentioned. 17% did not have disclosure of the valuer's interest or conflict, as he was mentioning earlier also. Disclosure of the valuer's interest or the lack of interest and lack of conflict of interest must be a specific item which is mandatorily presented in the report. A confirmation or affirmation to that effect is specifically expected and required under the rules. So like I was mentioning in the earlier page, when we were talking about other valuers who are involved, right? So in some cases, they had not mentioned the identity and details of the valuer who had undertaken such valuation, which has been relied upon. This is critical and important to be mentioned. There are minimum things which needs to be done. Identity of the valuer, whether he is a registered valuer and which class he is of a registered valuer, and what is the asset and the value which has been relied upon based on this report. So that the reader can also understand the criticality of that value to the overall value also. For instance, you are doing a business valuation for a company, and the company had some surplus lands. Let's suppose you had valued the business at 500 crores and there is some surplus lands of 20 crores. Obviously, you can't value the surplus lands because it's a pure land and building or lands in this case. So you have to necessarily depend on a land and building valuer. And let's say you give all these details and in 520 crores, then the reader knows 20 crores is based on other valuers. And so is the LNB valuer, registered valuer, etc. Now, this is different than a case where your business value is 20 crores and surplus land is 500 crores. Now, they are more interested in the credibility of the LNB valuer's report than yours, probably, right? And you are also relying on something which is substantially large, where you are not the expert. So you've just taken on that figure. So the whole reliability of the overall valuation is significantly higher on the basis of something else, which is not under your signature necessarily, right? So this is the critical thing. The parallel to this is what, you know, when we have a group audit and things like that, how they are expecting 80% of the components to be audited, and now NFRA is saying it's the parent company's auditors will have to own up for much more responsibilities to ensure that when they are giving a report and somebody is going to rely on it, it has to be based on numbers which they can stand by, not based on another third party's report alone. So, of course, under the valuation, the rules are clear. You have to rely on the subject matter specialist. So if it is a LNB, it has to be a registered valuer under LNB who's giving it. But the idea of giving indicating all those details and the values is the user can appropriately evaluate his comfort and reliability on those in addition to whatever he will draw from your report. So, like we were discussing, 3 critical dates to be included in the report. In around 10% of the cases, at least one of these were missing. So that is something which needs to be also specifically addressed, right? So that needs to be taken care. And as I was mentioning, the key thing is that in many cases, 1/3 of the cases, inspections or investigations were not undertaken. Now, when you look at it as 31% out of 85% where it was applicable, 15% of the cases it was not even applicable, right? The share increases, it becomes nearly 40% of where it is required, it was not given. So this is one key area where we need to focus. We need to see that our valuation reports are considering some information and presentation in this regard to enhance the quality of the reports we are providing and producing. The procedures adopted in carrying out valuation standards, again, 1/6 of the report did not contain, which is also fairly large, though in one way to look at it, yes, it's a fairly good amount of compliance, but from another perspective, there is a significant scope to improve. Nature and sources of information used is there substantially in most cases. Very few cases it was missed out. Restriction on use of the report again has been an area where there is a gap and a lot of miss outs. Again, nearly 1/6 of the cases did not have it. So this is another area, an aspect which needs to be addressed specifically and brought in to read, right? So in our valuation reports, this is another area where we can specifically ensure that we are addressing it and putting it in place. Major factors which are taken into account during the valuation, 1/4 of the reports did not have it. Like I was mentioning, if you see in the previous slide, inspections were not there in 1/3, and now 1/4 you don't have the major factors taken. So read, assuming there are interjections of the report where both these were not there, a significant amount of the credibility around the construct of the report, how we arrived at the conclusion which we have arrived in totality is missing. So this is something which needs to be clearly looked at. Caveats and limitations, there are slight improvements which are possible, right? That's something which can be looked at. Inclusion of information for intended users. Yes, there is a very high level of compliance with regard to the scope of assignment, the intended use, etc. very clearly. The key areas which needs addressing are disclosure of assumptions. When we are using assumptions, valuation assumptions, we need to first describe them, disclose them, and wherever it is relevant, give some rationale for that. So that is something which needs to be specifically considered. Then if you look at it, wherever there are special assumptions which are used in the valuation report, a significant amount of cases, it is not rationalized or given the proper disclosures. So that is something which needs to be acted upon with more serious addressing. Then one of the key things which are required for a valuation report is to start with the scope, the intended use, then we go to the premise of value and basis of valuation. Now, basis and premise of valuation itself is missing in some 1/6, more than 1/6 of the cases, which is a fairly high non-compliance in my personal view. Though overall the percentages will look as though 83% compliance is there. 1/6 of something so critical is concerning. We are not even saying whether we are valued based on going concern or liquidation basis. Where are we giving the clarity in our reports? Maybe it is implied somewhere, but it needs to be explicitly stated. Maybe because we have used a DC evaluation, one could take an assumption that it is done on a going concern basis, etc. But the fact is that we need to bring these out explicitly in the report. That is something which we need to consider. And wherever significant uncertainty is there, which can have an impact on the valuation, in many cases, it was noticed that there is no disclosure. So this again is an area which needs to be addressed and taken care of. Continuing on that, with information for the intended uses, under that criteria, if we look at it, limiting conditions that directly affect valuation, there is 70% disclosure. Again, there are many reports where these limiting conditions directly affect the valuation. though can be implied to be there, is not specifically explained and presented in the report. The reports are generally narrative and fairly comprehensive across, right, detailed, that part, except for where gaps were there. We're not talking about that, but in terms of the overall report. Executive summary is missing in 50% plus cases. So that is something which can be looked at more for better presentation and better understanding and ease of communicating. Variance from standard is only in very few cases. Additional requirements where it was required has not been reported. Actually, here it's only talking about the 1%, right? So, but that is something which is important. Where there was a requirement to vary, you have to explain it very clearly. ICA standard being adhered to, right, being specifically mentioned. Again, in a large numbers, the specific ICA standards have not been mentioned. It just says ICA VS are being followed. But which standards for what purpose it has been used have not been specifically stated. It could be a good idea to bring that in the reports. Sufficiency of compliance in communicating. Now, it's not only enough to prepare the report and etc., but to ensure that it is communicated well, right? Only 6% of the reports were marked as insufficiently communicating. By and large, very good compliance. Work performed also seemed to show by and large good performance. Conclusions reached also seem to give a good performance. Enough information within the report to enable a review of the report, right? There is improvement which are possible because only around 86% gives that kind of adequacy of information. And there could be additional information and additional inclusions in the report to enhance the sufficiency of communication in a comprehensive manner for this purpose. So looking at specific observations, some of the specific observations in one of the reports, discrepancies identified regarding the appointment date mentioned in clause 5 of the report titled Appointing Authority. The report states the appointment date as 10th May 2023, while the report itself is signed on 6th May 2023. The inconsistency is significant as the date of the report cannot precede. Now, this could be some typographical error, this could be some copy-paste error. So we need to ensure that we are also giving importance to that. For instance, in another case, it was noticed that the report, while detailing the various valuation approaches, talks of two different valuation approaches having been used in the report. But ultimately, when you look at the valuation computations, only one valuation method has been used. So the earlier portions were probably earlier thought or draft stage discussions, or maybe it was copied from a different report and edited for this report. Whatever it is, there is a significant error. In one side, you are saying you have used two different methods and you have given a certain weightage between them. On the other side, you are just finally giving computations based on only one method and the value based on that. In another report, while calculating FME, the valuer mentioned that PP has been taken at market value, but how it has been taken at market value, whether there was a P&M valuer was involved, what is his report, who's the identifying party there, what are the annexures to that, nothing is there. Few of the reports reference the determination of fair value using internationally accepted valuation standards. However, they fail to specify which valuation standards. Now, the law says you should do it under an internationally accepted valuation standard. Now, which internationally accepted valuation standards have you used has to be specified. It cannot be left open, right? So that is something which has been missed out in some cases. So you can't keep it very generic. You have to specifically state what are you using. In one of the reports, while calculating the cost of equity, the valuer has not provided any basis for arriving at the company-specific risk premium, right? So, so that is again a challenge. The components are not clearly described. How you are arriving at the cost of equity or WACC, whatever is used, is not described or detailed, leading it to be probably like feel like ad hoc number. It may not be, but feels like that. Disclosure of RV's identity in the report. In one of the reports, the cover page of the valuation report states that it's prepared by another professional without having any reference to the registered valuer. It does not reference the registered valuer's registration number issued by ICA RVO and IBBI. Furthermore, the report is signed by the valuer in a different professional capacity than an RV. The signature also omits the RV registration number issued by ICA RVO and IBBI. Now, very clearly, it says that the report has to be issued with the name of the registered valuer with all his identity and his numbers, registration numbers being given. So this is something which is missed in this. In another report, the valuer has been appointed to determine the fair value of equity shares of the investee company on 31/3/23, as well as its enterprise value as on the same date. However, despite providing calculations to ascertain these values, the report states the fair value and enterprise value as of 31/3/22 on both the cover page and within the report. This appears to be a typo error, but one doesn't know what exactly went on, right? So such critical things, you can't have major errors coming into it. In one of the report, the valuer mentioned that he has used ICA valuation standard 303 financial instrument. While looking at the nature of the valuation, he should have mentioned ICA 3 valuation standard 301 business valuation also. So he has quoted the wrong standard, but he has used something else. In one of the reports, after 100% growth in sales, these things could be because of, sometimes earlier report for some other client being taken and then modified. Today, we are all having soft copies. So this is another thing we have to be very careful. So there has to be a second check which is done for improving the overall quality of the output. In one of the reports, after 100% growth in sales in the last year of explicit period, there is a sudden drop in growth rate to 3%. This extensive fall in growth rate is neither explained nor justified in the report. So, wide variations and changes with no explanations. In the assumption section of one report, the valuer states, we confirm the accuracy of financials of the company provided to us. It is assumed that these statements are true and correct. So here you can see that they are contradictory. It should say we do not confirm the accuracy probably, right? But you are ending up giving a contradictory statement. So a certain amount of attention to detail is required for drafting. In another report, the valuer has used a discount for COVID-19 pandemic for a valuation date of 31/12/2022, far away from the COVID times. Theoretically, it is possible that there could be some impact in that particular company or industry, etc. But in such case, that should have been also part of his highlighted fact that why it is relevant. There should have been a rationale why the COVID-19 discount is relevant in December 2022 also, when he did this valuation, right? In the annexures, the valuer has used DLOM. Usually, DLOM is not used for book value method. It would have been better if the valuer had given a rationale behind using DLOM. So this is another thing. They have taken the book values to represent the fair values, and then they have given further discount on that. Yet another case, the valuer has mentioned in the report that he is required to determine the fair value of the equity shares as defined in valuation standards, right? But it appears that the fair value calculated as per 11 UA. Now, when you are preparing for income tax 11 UA, there is a specific rule, and that rule says how you should compute. And if you are computing fair value based on that, that fair value is not what is defined under the valuation standard. So your description, disclosure, everything will have to be aligned to appropriately put it in perspective and give it. So that had been missed out in this case. Further, in the same report, the valuer has stated that the ICA valuation standards has been followed. However, it appears that the book value of unquoted investments have been used as fair market value, which does not comply with the ICA valuation standard. So now, see, many a times we can consider when there is an asset-wise valuation which is being done for a company for some reason, it is possible that maybe, the trade receivables in the normal course is considered as the book values as being the fair value, the inventory value being considered as the book value being the fair value, reflective of the fair value, so that you can take them either as the market approach, as the fair values which can be seen in the market, or as replacement cost, considering these as the fair values of such assets. However, the same cannot be applied. The book value cannot be taken for PPE, land and buildings, and investments. Now, in the building PPE, necessarily there has to be some application of mind to arrive at how the fair value is to be, fair market value, especially to be determined, which may be significantly different from the book values. Now, this is something which has not even been considered in this case. They've missed it. They've taken the book value and taken it. In that context, I just wanted to also add something which probably is covered or not covered. Technically, under the ICA valuation standards, net asset value, right? NAV method. When we say NAV method, we presume book values to be the NAV. Book values as it is being taken as NAV is by itself not a method which is prescribed in the standards anywhere. So where and how are we actually taking book values and doing it? Let's assume for a moment there is no land and building or no material plant and machinery, right? So it's only so the presumption you are making is that the carrying values are reasonably indicative of their fair values or their replacement costs. So you are using a cost approach saying that these are the replacement costs. My debtors is carried at X crores. That is reasonable of the replacement cost of the debtors. And my inventory is of Y crores, and that is reasonable to consider as the replacement cost of the inventory of the same nature, right? So that is how you are taking it. So when you are using something like that, you have to, when you come to at least these 2, 3 items, like land and building, fairly substantial plant and machinery, investments, you need to necessarily replace with the fair value determined for those items based on some other method, and you cannot go by book values alone, right? Even for plant and machinery, where it is not material, maybe it is possible, but for land and building, significant plant and machinery or investments, no way. So this is something we need to keep in mind. and address it. Thought I could also share at this point as a thought. Coming to the next thing, in another report, the company's most significant assets consisted of unquoted investments in several other companies. Therefore, it would have been preferable for the valuer to provide detailed working for the valuation of these investments and specify the method used for their valuation, because the company's biggest asset is only investments in other companies which are unquoted. Now, you can't just take the book values. You need to necessarily go value those individual investee companies, then determine this thing, and you should explain what is the method you have used for valuing those companies, etc. So that has been completely missed. Nothing has been given in that regard. One key observation from a report is that the whole report is only a generic description of the process adopted and does not include any computations in the determination of the values arrived, including key valuations such as computation of WACC, discounts applied, etc. So the whole report is only generally saying that we have considered just to give you an example, we have considered the appropriate risk-free rate and the applicable enterprise risk premium and the adjusted for appropriate discounts which are specific for the company's position to arrive at a WACC of 25%. Now, what is this? So this is something which needs to be clearly more detailed digging is required and presentation is required. Can't be just generic words which are thrown. It is noticed that the detailed projections and computations for the various valuations undertaken for the parts valued using the DCF method, right? Recent round of infusion method have not been detailed in the report. So nothing is there. It just says we have used the DCF method and gives the value. It doesn't say how that computation has been made. There is no details which are provided. Further, it is noticed that the report is also not giving details of the computations and assumptions such as WACC and discounts used. It may be understandable to not share financial information, including projections, in certain cases for confidentiality purposes. However, the key valuation assumptions used and their computations must be disclosed. Now, there are times when, for example, if valuation is being done for the purpose of some merger, demerger, etc. For confidentiality, you don't want the future projections to be put out, etc. So obviously, those are not included in the report which is shared, but kept as workings in the file of the valuer. However, at least all the key valuation assumptions used, their rationale, their computation should get disclosed. Cannot be that nothing is disclosed in the report. It's only generic English and final number. So with that, we are coming to what are the recommendations which are coming up from this peer review exercise, which has been carried out over this period. One second. So the peer review exercise recommendations which are coming from there are essentially one, you mentioned specifically the valuation standard used in the report, right? Wherever possible, you also further give details of which valuation standards have been used under that. Okay. Then inclusion of company's background and industry context. So this is something which is again critical. The background information is very, very important for one to understand how the valuation has been approached itself, right? Then express mention of the appointing authority. though only in few cases it was missed out because it's a mandatory requirement under the rules. Who has been the appointing authority should be specifically given in the identity of the valuer and any other experts involved in the valuation that should be brought out. Any conflict of interest or lack of such conflict of interest should be specifically stated. So similarly, the other thing is the engagement letter or the appointment letter date. So that date being given is also to be mandatorily, ensured, because it's again a regulatory requirement, because the rule specifically asks for these to be included. Mandatory disclosure of inspections and investigations. Again, there is a subclause F which is asking for this to be mandatorily included, and we saw that in a significant number of cases this is not being included. Very important to have this. In this context, I should also tell you, see, whenever there is a projection-based DCF being done, and the company has been in operation for some time, especially, then there should be a bridge explaining how the past performance and the future projections are linked and what is going to make this happen. So this itself is missing in some cases. They don't present any numbers there. They just give one projections and say this is what has been done. So how is that projection comparing with, say, the last year's actual and maybe last 2-3 years trend or anything? Nothing is there. And why is it expected to significantly differ if it is so? All that needs to be explained. So that is very important, critical to include. Disclosure of the nature and source of information used or relied. Very few cases only it was missing, but mandatory, so needs to be enhanced and covered, right? The procedures adopted in carrying out the valuation standards. This also should be detailed out. This is very important. The restriction on use of reports. As I was mentioning, nearly 1/6 of the report this was not there. This should be clearly there, covering two things. One is the purpose, and second is the timeline beyond which it should not be used at all for any purpose, including the purpose for which it is being given. The major factors which were there in 1/4 of the report was not there, if I'm right? And this is also another important thing which needs to be captured very clearly. And again, as subclause J of the rule specifically expects this, this is also something to be included. Conclusions reached, by and large, it was there. Very few reports did not have. That's an improvement which can be made. Caveats, limitations, again, a few reports did not have it. It can also be improved to enhance the presentation and report. Disclosure of assumptions and special assumptions is very important, because this is bringing out clarity. This is bringing out the rationale. This is giving more transparency in regard to the whole report. So this is something which should be specifically included in the report. The base of value and the premise should be explicitly stated, because it's a specific requirement. And also, this is the crux of this. What is that valuation we are doing? Is it going concern value? Is it liquidation value? Is it the Habu? What is the premise we are using? What are the bases we are using? It has to be there very clear, right? And wherever significant uncertainty is affecting valuation, there should be more detailed disclosures which are there. And similarly, any limiting conditions should also be enhanced. It will be good to always have abbreviated summary or executive summary, which is given in the report. But that is only a value add which can be brought in. It's good to have and makes it easy for multiple layers of people understanding and utilizing the valuation report easily comprehend. Those who are at a different level, they may only want to see the executive summary and move forward. There may be people who would want to look at the whole report to get a comprehensive view in the process of this. So it could help all of them in the process. Values identity, like we've seen in some cases, the important thing is the report, everything should have the values identity, the name, the numbers, everything very clearly brought out. And wherever there is other values who have been used, very rare cases only we found that it has been used, also be available in full details. Drafting consistency and drafting errors are seen in many cases. So this is something which needs to be very clearly addressed. Maybe it's a good idea to have a second person reading the report to ensure that the quality of presentation and errors like these are minimized. Explicit mention of applicable statutory provisions, especially when it is being done for a different purpose. For example, when you're using 11 UA evaluation or you're using evaluation under IBC or doing evaluation under SEBI REIT regulations, etc. So you specifically bring those regulations and what it expects. So that is very important to bring out the clarity as to what is the basis on which the computations are being made. And wherever computations are there and there are assumptions and assumptions themselves require computations, all those should be specifically detailed out, except where for some confidentiality reasons, some data is not being presented. Along with this, what is being detailed out, that should be also rational. Like we were mentioning, cost of equity calculation should be given specifically, right? With that, we come to the end of what was planned in this session. If there are any specific questions, we could take that. I think this is more of a sharing the findings from the peer review. However, if there are any specific questions, I don't know whether there is a scope to put their questions in chat box or otherwise.
Sir, there are no questions as of now for the session.
Okay.
With this, we would like to thank you so much, Balasubramanian sir, for your insights and observations on the findings arising from the peer review of the 168 valuation reports which were done by ICI RBO's RVs for the financial year 23-24. We are positive that the observations and the insights shared here today will enhance the quality and credibility of the valuation assignments being undertaken by the practitioners going ahead. We would also like to thank all the participants for their patient listening and engagement in the session. With this, we would like to close the session. Once again, thank you so much, sir, and the participation and the participants for making this session a success. Thank you, sir.
Thank you very much. Thank you all for the patient listening. Thank you.
Thank you, sir.